If you've been quietly stacking silver, tucking away coins, bars, or rounds in a safe somewhere in your home, I need you to stop what you're doing right now. Because what's happening in the silver market is unlike anything most investors have witnessed in their lifetimes. And I mean that seriously, not in the way financial YouTube hyperbole usually means it. I mean, there are structural forces converging in the silver market right now that the people managing your retirement account almost certainly haven't told you about. And if you don't understand what's happening, you may be sitting on an extraordinary opportunity, or you may be making a very costly mistake without even realizing it. So pull up a chair. This is going to take a few minutes, but I promise by the time we're done, you are going to look at that silver in your safe and possibly your entire retirement strategy very differently. Let's start with the most basic question. Why is silver sitting in people's safes in the first place? For most folks who found their way into physical silver, it started as a hedge, a quiet insurance policy. Something they bought years ago, maybe after watching the dollar lose purchasing power, maybe after a friend convinced them, maybe after a sleepless night reading about what happened to currencies throughout history. They stuffed it in a safe, told maybe one or two people it was there, and largely forgot about it, checking on it the way you check on an old savings bond, occasionally, half-heartedly, with no real urgency. That era is over. Because right now, at this very moment, the silver market is experiencing its sixth consecutive annual deficit. 6 years in a row where the world consumed more silver than it produced. Think about that. If your household spent more than it earned for 6 straight years, you'd be in serious trouble. The same arithmetic applies to commodities. Supply deficits don't resolve overnight. They build, they compound, and eventually they explode. The Silver Institute, which isn't some fringe newsletter but the authoritative global body tracking silver supply and demand, has confirmed that total demand continues to outstrip total mine production, with a deficit of tens of millions of ounces. Tens of millions of ounces that simply don't exist. That gap has to be filled somehow, and the way markets fill that gap is through price. The price has to go high enough to choke off some demand and incentivize new supply, and we are nowhere near that equilibrium yet. Now, here's the thing that makes silver different from almost any other commodity on the planet. Silver isn't just a metal people buy because it looks pretty. It isn't just a safe haven like gold. Silver is simultaneously one of the most critical industrial inputs of the 21st century. And that industrial story is what most people sitting on physical silver completely miss, including, frankly, most of the people telling them to buy silver in the first place. Let me paint you a picture of the world silver is being consumed by right now. Every solar panel ever manufactured requires silver. Not might require it, requires it. Silver paste is used in the photovoltaic cells that convert sunlight into electricity, and there is currently no commercially viable substitute. The solar industry has been on a tear for years. China alone has been installing solar capacity at a pace that would have seemed science fiction a decade ago. The International Energy Agency has called this the largest industrial build-out in human history. Every single panel in that build-out uses silver. Demand from the solar sector alone has grown massively, and there is no sign of that slowdown. Then add electric vehicles. Your modern EV uses roughly double the silver of a conventional internal combustion engine vehicle. The charging infrastructure those vehicles plug into? Also silver intensive. The smart grid upgrades happening across the developed world to handle the new electrical load? Silver. The 5G network build-out? Silver. The AI data centers requiring massive amounts of power and advanced circuitry? Silver. Researchers at Stanford published findings suggesting next-generation solid-state batteries could use 2 to 3 times the silver of current lithium-ion configurations. That's not a niche application. That's the future of energy storage. So you've got a world where demand from industry alone is accelerating, not because of speculation, not because of fear, but because of the physical requirements of the technologies being built right now. And into that rising demand, you have supply that simply cannot respond quickly. Here's why mining supply can't just magically fix this. Silver is, and this surprises a lot of people, primarily a byproduct metal. About 70% of the world's silver supply comes not from dedicated silver mines, but as a byproduct of mining copper, lead, and zinc. That means when copper prices are under pressure, mine operators don't crank up production because silver demand is high. They make decisions based on the primary metal. Silver is almost incidental. The result is that silver supply is structurally constrained in ways that simply don't apply to metals where you can build a dedicated mine and just run it harder when prices rise. It takes 10 to 15 years to bring a major new mine online. The years of underinvestment in mining infrastructure during the previous low price cycle means the supply response to current demand is going to be achingly slow. Now, before I go further, I want to pause for just a second because if you're watching this and you're sitting on retirement savings, whether it's in an IRA, a 401k, or a pension, and you've been wondering whether precious metals make sense as part of your strategy, I put together a free guide specifically on that. It walks through how ordinary retirees are using simple legal structures to protect wealth from inflation and market volatility. It's in the description below. Completely free, no obligation. Just check it out. Okay, back to what's really happening under the surface. The most alarming development in silver right now isn't even the above-ground supply story. It's what's happening in the futures markets. Specifically, what's happening at COMEX, the commodity exchange in New York, which is where the price of silver is officially set every single day. Here's how COMEX works, in plain English. When you buy a silver futures contract, you're buying a promise, a piece of paper that says, I have the right to receive silver at this price on this date. The system works on the assumption that most people never actually take delivery. They're speculators, hedgers, traders. They're not going to show up with a truck and demand silver bars. They settle in cash. This assumption that paper promises and physical metal can operate as basically the same thing has been the foundation of the modern silver pricing system for decades. But something has shifted dramatically. COMEX registered inventory, the silver that is actually sitting in vaults and available for delivery, has been declining, and the ratio of paper contracts outstanding to deliverable physical silver has become extraordinary. Some analysts are now citing figures suggesting there are more than 7 paper claims for every single ounce of registered silver in the vaults. 7 to 1. Think about what that means. If even a fraction of futures holders decide they want physical delivery instead of cash settlement, the exchange faces a delivery problem it may not be able to solve. This isn't theoretical. Earlier this year, market observers watched COMEX silver inventory drop sharply in a very short window, millions of ounces, withdrawn in a matter of days, sending a clear signal that large entities were pulling real metal out of the system. Not paper, not promises, real silver bars, loaded onto trucks, moved to private vaults. When the big players start hoarding physical metal rather than leaving it in the exchange system, that tells you something about their confidence in paper claims. They want the real thing. And this is where the story starts to feel, for those who know their history, extraordinarily familiar. Cast your mind back to the late 1970s. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, 2 Texas oil billionaires, decided they wanted silver. Not futures, not ETFs, not paper silver. Physical silver. They began accumulating. At the peak, they reportedly held contracts for something in the neighborhood of 200 million ounces. The silver market at the time was a fraction of its current size. Their buying sent the price on a vertical trajectory that stunned Wall Street and shook the global monetary system. At one point in early 1980, silver had risen roughly 700% from where it started just a couple of years prior. The exchange authorities eventually changed the rules, literally in the middle of the game. They went to liquidation-only trading, meaning you could sell your contracts, but you couldn't buy new ones. That rule change broke the market. Prices collapsed, and the Hunts lost billions. The lesson most people took from that episode was that the Hunt brothers were reckless and ultimately foolish speculators who got what was coming to them. But here's the lesson that gets buried. They were right about the underlying fundamentals. The dollar had been severed from gold just years earlier, in 1971. Inflation was running in the double digits. The purchasing power of savings held in cash was being systematically destroyed. The Hunts understood that hard assets, metals you can hold in your hands, would preserve value when paper promises could not. Their timing and their leverage killed them. Their thesis was not wrong. Now fast forward to today, and ask yourself how different the underlying picture really is. The dollar has been the world's reserve currency for decades, but that status is under more pressure than at any point since Bretton Woods. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing roster of countries, have been loudly and publicly discussing alternatives to dollar-denominated trade settlement. China and Russia have been settling bilateral trade in local currencies for years. Saudi Arabia has held conversations about accepting payment for oil in currencies other than dollars. The petrodollar, the system that has underpinned dollar dominance for 50 years, is being stress tested in ways it never has been before. This matters for silver because silver, like gold, is money without counterparty risk. It doesn't depend on any government's promise, it doesn't default, it doesn't get inflated away. In a world where dollar hegemony is eroding, hard money assets are regaining the strategic relevance they held before the modern fiat era. Central banks around the world have been buying gold at a pace not seen in decades. They understand what a multipolar currency world looks like, and they are positioning for it. Silver, which is gold's historically undervalued cousin, tends to follow gold's monetary moves, with more velocity. Consider the gold to silver ratio for a moment. Right now, that ratio sits at roughly 62 to 1, meaning you'd need about 62 ounces of silver to buy 1 ounce of gold. Historically, over centuries, that ratio has averaged somewhere between 15 and 20 to 1. In the ground, geologically, silver is found at roughly a 9 to 1 ratio versus gold. For most of monetary history, silver was priced closer to that geological reality. Even in the modern era, the ratio has compressed dramatically during bull markets. In 1980, it touched below 20 to 1. In 2011, during the last great silver bull, it compressed to around 31 to 1. If that ratio were to return to even its modern bull market average, silver's price relative to gold would need to roughly double from where it is today. And if the monetary demand story starts to really fire alongside the industrial demand story, which is what's beginning to happen now, ratio compression to historical norms is not a fantasy. It's a pattern that has repeated across multiple cycles in the modern era. And here's the thing nobody in the mainstream financial press wants to talk about. Retail investors, ordinary Americans, are waking up to this story in ways they weren't just a few years ago. Coin shops across the country have been reporting premiums on physical silver, the difference between the spot price and what you actually pay for a coin or bar, that remain elevated, reflecting genuine tightness in the physical market. When you see sustained premiums above spot, that's the market telling you something. Spot price is a paper price. The premium is the physical market's honest assessment of actual scarcity. Meanwhile, ETF inflows, the institutional and retail money chasing silver through paper vehicles like the iShares Silver Trust, have been growing. The Sprott Physical Silver Trust has been raising capital specifically to buy and store physical silver. These aren't fringe operations. These are major financial vehicles, and they're all competing with industry and with central banks and with private individuals for a finite and constrained physical supply. This brings me to something I want to say very directly to the people watching this who are at or near retirement age, because this matters enormously for how you think about what you hold and where you hold it. If you have silver in a safe at home, you understand the value of physical possession. You understand, probably intuitively, that there's a difference between owning something and owning a piece of paper that says you own something. That instinct is sound. But here's the conversation most people in your position haven't had. There are legal, IRS-approved structures that allow you to hold physical precious metals, not paper, not an ETF, but actual physical gold and silver, inside a retirement account, with the same tax advantages as a traditional IRA. This is a gold IRA, or a precious metals IRA, and it is a legitimately powerful tool for people who want the protection of hard assets without giving up the tax wrapper that makes retirement savings so powerful. If you have $100,000 or more sitting in a retirement account, a 401k you rolled over, an IRA, any kind of qualified plan, and you're concerned about what a market downturn, a currency crisis, or a geopolitical shock could do to that wealth, a portion of it in physical metals held in a qualified account is worth serious consideration. There's a free guide in the description below that breaks down exactly how these structures work, the questions you should ask, the pitfalls to avoid. I put it together specifically because I kept getting questions from people who had the right instinct but didn't know the mechanics. If that's you, it's in the description. Now, where does price go from here? I want to be careful here because nobody can tell you with certainty where silver is going or when. Anyone who tells you they know the exact timing is selling you something. But I can tell you what the structural forces suggest and let the evidence speak. Silver hit prices above $100 per ounce earlier this year. It has since pulled back, dramatically. Markets don't go straight up. They never have. And silver, more than most assets, has a history of violent corrections within larger bull trends. In 1979 to 1980, silver corrected 30% on its way to its ultimate peak. In 2010 to 2011, it corrected more than 25% several times before eventually topping. Those corrections shook out weak hands. They destroyed confidence. They caused people to capitulate, to sell at the bottom, locking in losses, right before the next leg higher. The current pullback is happening against a backdrop where none of the underlying fundamentals have changed. The deficit is still there. COMEX inventory is still stressed. Industrial demand is still structural, not cyclical. The monetary tailwinds haven't gone away. What has changed is sentiment, which is fickle, and positioning, which can unwind quickly and just as quickly rebuild. The analysts making the highest long-term forecasts for silver, some going as far as projecting prices that would seem extraordinary by today's standards, are basing those projections not on wild optimism, but on supply-demand arithmetic, combined with historical precedent for what happens when monetary demand meets structural supply constraints. Citibank, Goldman Sachs, and several major banks have published research in recent years noting silver's extraordinary potential as both an industrial and monetary asset. The numbers they put on paper are not fringe numbers, they're institutional numbers. And yet, most American retirees have zero silver exposure. Zero. Their financial advisors have them in a mix of stocks and bonds and maybe some real estate investment trusts, and they've never once had a conversation about a hard asset that has been monetary money for literally 5,000 years of human civilization. There's a reason for that, and it's worth understanding. The financial advice industry is structured around products that generate ongoing fees. Stocks, bonds, mutual funds, annuities, all of these generate management fees, advisory fees, commissions, some combination thereof. Physical silver sitting in your safe generates zero fees for a financial advisor. So there is a structural incentive in the advice industry to steer you toward paper assets and away from physical hard assets, even when the fundamental case for those hard assets is overwhelming. The people who understand what's happening in silver right now, the sophisticated institutional players, the family offices managing serious wealth, the commodity desks at the big banks, they are not sitting on their hands. They are not waiting for permission from their financial advisor. They are accumulating. And they are accumulating quietly because they understand that the moment the broader retail market really wakes up to this story, the dynamics of the physical silver market change dramatically. Think about the numbers. The total above-ground investment-grade silver in the world, the refined silver that exists in bar and coin form, in vaults and in safes, is not a large number relative to global financial assets. If even a modest percentage of retirement savings, pension funds, or sovereign wealth shifted towards silver as a store of value, the demand would completely overwhelm the available supply at current prices. That's not a conspiracy theory. That's arithmetic. The great monetary historian Jastrom wrote in Silver, the Restless Metal, about silver's extraordinary ability to preserve purchasing power across centuries, not years, centuries. Empires rose and fell. Currencies came and went. Silver remained. The Roman denarius was debased over centuries until it held almost no silver content at all, and the Roman economy collapsed. The Spanish Empire flooded the world with New World silver and built the first true global currency system on it. The United States itself was founded on a bimetallic standard where both gold and silver were legal money, a fact that somehow gets forgotten in the modern era of purely digital currency. That history matters because it tells us something about what silver is. Silver is not a trade. Silver is not a hot tip. Silver is money that has survived every economic system humans have ever tried, including all the ones that eventually failed. And we are living in a moment where the economic system, the dollar-centric, debt-financed, globally interconnected system, is showing stresses it hasn't shown in a very long time. The geopolitical picture alone should give any serious wealth preserver pause. Trade wars, tariffs, sanctions, the weaponization of the dollar through SWIFT exclusions. These aren't abstract policy debates. They are active processes reshaping the global financial order in real time. When one country can freeze another country's foreign reserves with a phone call, every country on Earth recalculates how much of their wealth they want to hold in assets that can be frozen. The answer, increasingly, is less. And the alternative, metal that sits in a vault or a safe and cannot be frozen, sanctioned, or inflated away, becomes more attractive, not as speculation, but as fundamental security. So here's where we land. If you've got silver in a safe, congratulations. You've been holding one of the most fundamentally sound assets in the world at a time when the case for hard money has never been stronger. But here's what you need to check: not the silver itself, the context around it. Are you relying too heavily on that silver as your only hard asset protection? Silver is volatile, wonderfully, magnificently volatile in a bull market, but the swings can be stomach churning. A diversified hard asset position, including gold, changes the risk profile significantly. Gold at current prices is a different kind of anchor than silver: more stable, more immediately liquid, more universally recognized as a monetary reserve. Is the silver you hold sitting outside any kind of tax-advantaged structure, meaning you're bearing all the tax risk personally on any gains? There are structures, perfectly legal and well-established, that allow you to hold physical metals in a qualified retirement account and defer or eliminate the tax on gains. If you're not using those structures, you may be leaving substantial money on the table. And this is the hardest question: is your overall wealth positioned for the scenario where the current level of market stress doesn't just linger, but intensifies? Where the equity markets face the kind of structural reset that happened in 2008 or 2001 or 1929? Because in each of those episodes, the people who came through in the best shape were not the people who were 100% in stocks. They were the people who had hard assets, who had some portion of their wealth in something that maintained value when paper assets were being marked down catastrophically. I'm not saying catastrophe is certain. I'm saying the insurance against it has never been cheaper in relative terms, and never been more justified by the actual fundamental situation in the market. The silver in your safe is a start. Whether it's enough, whether it's structured correctly, whether it's part of a comprehensive hard asset strategy, or just a small slice of a portfolio still heavily exposed to all the risks you were trying to hedge against, that's the question worth asking right now. Not in 6 months, not after the next market event makes the urgency obvious to everyone. Right now, while there's still time to be thoughtful about it. A handful of people who made it through the 2008 financial crisis with their retirement intact weren't lucky. They were prepared. They saw the imbalances, the leverage, the debt, the paper promises that couldn't all be kept, and they acted before the crowd did. They weren't geniuses. They were just paying attention to the things that actually matter and willing to act on what they saw. The imbalances in today's silver market, the COMEX inventory stress, the 6 consecutive years of structural deficit, the industrial demand that's only accelerating, the monetary tailwinds building from de-dollarization, the paper-to-physical ratio that makes 2008's mortgage leverage look manageable. These are real. They're documented. They're confirmed by institutional research, by government data, by the Silver Institute's own numbers. This is not a fringe story. It is the story that the financial mainstream hasn't caught up to yet. You, sitting there with silver in a safe, have already caught a piece of this story. The question is what you do with that head start. Check the description below. There's a free guide there that breaks down exactly how retirees are using simple, legally structured accounts to hold physical precious metals and protect their hard-earned wealth. Thousands of Americans with significant retirement savings are already doing this, not because a broker told them to, but because the math, the history, and the current market reality left them with no other logical conclusion. And if you've watched all the way to the end of this video, which tells me you're serious about protecting what you've built, I want to make you a specific offer. If you mention this video when you reach out through the guide in the description, you'll get access to a complimentary one-on-one educational web conference. No obligation, no sales pressure, just a direct, thorough walkthrough of exactly what a gold IRA is, how it's set up, what it costs, and whether it makes sense for your specific situation. That offer is exclusively for American retirees who have at least $100,000 in any type of retirement account. It's not available publicly. It's available because you stayed, you listened, and that tells me you're the kind of person who takes your financial security seriously. The silver in your safe already told you something about yourself. Now it's time to find out if the rest of your strategy is telling the same story.